Introduction. You've spent decades working, earning, and hopefully saving. Now you're either already retired or thinking about it, and the way you manage money has fundamentally shifted. There's no longer a steady paycheck replenishing your bank account every 2 weeks, which means every financial decision carries a bit more weight. Investing at this stage of life isn't about chasing the next big thing or taking wild risks. It's about making smart, steady moves that align with where you are now and where you want to be in the coming years. There's also a mental shift that happens in your 60s. Earlier in life, investing was largely about accumulation, building wealth, taking risks, and letting time smooth out the ups and downs. But now the focus leans toward preservation, income generation, and yes, still some growth. After all, retirement isn't a finish line, it's a phase that could last 20 or 30 years, and your money needs to keep working for you the whole time. Risk takes on a new meaning. In your 30s or 40s, investing in a few high-risk, high-reward stocks might have been an exciting gamble. If a stock tanked, you had time to recover. But in your 60s, the risk equation looks different. There's less time to bounce back from a major loss, and that means choosing investments with a bit more stability. This doesn't mean avoiding risk altogether. Inflation, for example, is a very real risk. If your money isn't growing at least a little bit, it's shrinking in purchasing power. The challenge is finding that balance, investing in ways that offer steady returns without exposing you to unnecessary volatility. Dividend-paying stocks, bonds, and real estate investment trusts, REITs, are often good middle ground options, but the key is understanding what level of risk makes sense for you. Income matters more than ever. Earlier in life, you likely invested for growth. The goal was to buy stocks or funds that would increase in value over the long haul, even if they didn't provide much or any immediate income. Now the focus shifts toward generating reliable income streams. This is where dividend stocks, bonds, and annuities come into play. Dividend-paying stocks, for example, can provide a regular cash flow while still offering the potential for growth. Bonds, particularly municipal or treasury bonds, offer stability, though they tend to have lower returns. If you have a pension or Social Security, your investments can serve as an additional layer of income rather than your sole financial support. It's also important to think about taxes. Some income sources, like Social Security or withdrawals from a traditional IRA, are taxed differently than income from dividends or capital gains.
Sample complete. Ready to continue?